Hello friends, last week in my video, I told you that I had some concerns about the market and I was expecting the markets to fall. And fall they did. I also shared in this video, the thumbnail which you can see on your screen, sectors and companies which were in particular businesses whose shares would fall. And what a spectacular fall. The video itself was prophetic, it was prescient, and now it's time to take it one step further. Are the markets done falling? Will the markets bounce back? Is there relief in the coming week? This is the crux, the topic that I'm going to grapple in this week's video. I'm Vijay Bhambwani. I'm a prop trader. I run a prop trading company. I've been in the market since 1986. This is my 36th year in the market, and I want to help my friends and followers become better traders. So let's plunge right in. Coming up on your screen is the market roundup window, which shows that the bank Nifty fell more than the Nifty 50, which is not surprising because inflation, the currency and overseas markets are expected to hit financials first. Bullion fell because the dollar continued its upward march. The US dollar index rose almost 0.75%. The USD INR gained a little over 0.5%, which means the rupee weakened 0.5% against the US dollar. And we are now at a new low. All right. So what we are likely to see is an impact of imported inflation. Any and everything that we import is likely to become more expensive, and India is a net importer with 2/3 of our imports being fossil fuels. Now, the 10-year benchmark bond yield eased a little bit because defensive buying started coming back in bonds, which is a good thing, and that basically cushioned the decline in the bank Nifty. The market-wide MWPL rose a little bit, which is along expected lines after expiry. Nothing new here. But what I feel is the crux of the data that I want to share with you is in the NSE market capitalization falling by almost 5.5%. Do remember last week I shared the information with you that any time when the NSE market capitalization has fallen more than, equal to, or more than 4% for 3 to 4 consecutive weeks, it has led to significant bearishness in the market. And last week and this week combined together, we have seen a little under 10% decline in market capitalization, and the bulls are obviously under severe amount of stress. Now, as along last week, we saw the US markets, the overseas cues turning even more bearish. All the indices, the Dow Jones, the Nasdaq and the S&P 500 declined over 2%. On your screen now is a chart of the Dow Jones Industrial Average, which I have been pointing out to you has hit a death cross, where the 50-day moving average is below the 200-day moving average, and therefore more falls are likely. Take a look at the Nasdaq 100 technology-based index that has hit a death cross in early March this year itself. Now on your screen is the S&P 500, which has also hit a death cross in early May. Now friends, a lot of you must be wondering whether the Indian indices have hit a death cross. So far, so good. Neither the Bank Nifty nor the Nifty 50 have been hit by a death cross. But the 50-day moving average is now approaching the 200-day moving average, although a downward crossover in any of the indices has not yet occurred. But the bulls are severely under pressure. On Saturday morning, I have sent you a WhatsApp broadcast, a free WhatsApp broadcast, giving you 10 charts which have exhibited severe examples of weaknesses due to the death cross occurring in them. If you wish to receive our free WhatsApp broadcast updates, do send me a message on the number above, and we'll get you going instantly. So coming back to the indicators, we now see the market-wide MWPL rising along expected lines. Do remember, till the third week of any derivative expiry, MWPL continues to rise, and then it peaks out a few days before the expiry day itself. The weekly chart shows a similar case, but do note how we are now topping out well under 30%, where 6 months ago we used to hit 32, 33, even 34%. So risk appetite is definitely down, and that's not really very good news for bulls who are hoping and holding on to long positions. Risk appetite, my friends, is down, so you better be realistic and be very, very careful. Let's now go to individual stock futures and the index futures turnover. Do remember, this daily chart is of 3 cumulative expiries, which is May, June, July. And what you are seeing is a week-on-week rise in both the segments, individual stock futures as well as index futures, where turnover is concerned. And also remember that this week, we've seen declines in both the indices and individual stocks, which means the one marshmallow traders have been comfortable selling. Now, if traders are comfortable selling, I would say that the prices are going to fall a little bit more. What does the weekly chart of the index and stock futures turnover say? A similar story. The volumes have been rising now for a fortnight across the board, and in a fortnight, there are no prizes for guessing. Markets have only fallen, which means that there are likely to be more declines before the market can find a bottom. Let's now come to the basis. Now, the basis is nothing but the premium enjoyed by the futures over spot, something like the options premium. In the beginning of the derivative cycle, basis is high, and as expiry comes closer, the basis goes progressively lower. But this chart on your screen is a 20-day chart and therefore a very limited time period. Do note how the basis has been constantly falling even before the expiry and the beginning of the new derivative cycle of May, which means the two marshmallow guys, don't worry about the marshmallow theory, I've got you covered. The hyperlink to the marshmallow theory tutorial is in the description below this video. It's in a pinned comment below this video, and it will appear as a hyperlink in the end screen of this video. So note how the two marshmallow theory traders' risk appetite is coming down sharply, and although expiry is a long time away, both the indices are almost marginally above zero. Let's take a look at the weekly chart of the basis of both the indices. Now, this is a telling picture. This is a little more worrying than what you would have seen otherwise, because the basis has compressed very sharply in the last 1 month. And do note that the markets have been falling precisely for that period itself. So the bulls are very reluctant to lend support at lower levels, and unless that happens, I would not say that the markets are bottoming out or have bottomed out. All right. So the basis is a leading indicator, which means it tells you in advance that the markets are turning, and there are more leading indicators. I'll walk you through them as we go along the way. MWPL, of course, is one of them. The basis is the next. And I update all these indicators on my social media accounts each and every day. So do connect with me. My contact coordinates will come at the fag end of this video, and I'll help you going and become a far better trader. Now, the third advanced leading indicator that I want you to note. Now, since this is a leading indicator, it will tell you upfront that the bulls are coming back or not. Now, this is the advanced decline ratio, a very simple metric, which means the number of shares rising versus the number of shares falling. Do note all 4 days, the first 4 days, Monday to Thursday, the advanced decline ratio was below 1, which means there were more shares falling as compared to rising. But on Friday, thanks to the initial gap up open, the advanced decline ratio has jumped to 2. That means for every two gainers, there was only one loser. Can this hold up? We'll have to wait and watch. And we need to basically keep our ear to the ground with a broader perspective. So let's take a weekly chart. Now on your screen, you can see a 20-week time period. You are seeing that the advanced decline ratio is above 1 after staying below the 1 threshold for 3 consecutive weeks. And it is now at a 5-week high, 4 or 5-week high. Will it sustain? Now that is the biggest question. So out of the 3 leading indicators, which is MWPL, basis and advanced decline ratio, only one, which is the advanced decline ratio, is showing any signs of optimism. Let's now go through other indicators as well and see what's happening. Now let's see the Impetus chart. The Impetus chart is something that you're used to seeing for over a year now. You banked on it, you've loved it, you've given me a lot of positive feedback, and the daily chart tells me that the Nifty's Impetus is showing signs of fatigue. Now that's a sign of concern. I'm going to come to Impetus in greater detail because I have some insights for the Impetus indicator. I've been using this now for over 5 to 6 quarters after inventing this, and I've made some observations. Now the fact that the Nifty attempted to rise on Friday but the Impetus fell tells me that the bulls were slightly weak. Although they were there, they were present, but they were weak. Relatively speaking, the Bank Nifty Impetus is better poised because even on Friday, it rose compared to Thursday. And do remember what I've been telling you for the last couple of weeks, the Impetus had hit a multi-week low. And I told you the markets will explode with volatility because the Impetus has fallen too much too fast. The reverse has happened now in the last 1 fortnight. The Impetus has risen too much too fast. Now let's see that same picture on a weekly time frame where you're watching a 20-week chart, 2.5 month perspective. What do you see? What I'm seeing is that the Nifty Impetus is almost within a kissing distance of a 20-week high. 20 weeks, 2.5 months. And the Bank Nifty is at approximately like 7-week high. What does that tell you? That the Impetus has risen a bit too fast. It needs to quieten down a little bit. Does it mean, and the Impetus has risen on falling markets, does it mean that the fall will become slower? Chances are yes. The fall can become slower. Will the fall suddenly stop and reverse? That seems like stretching it. It might bottom out somewhere and then give you a temporary blip up. But I'm not saying that on Monday morning itself, all is well, all is well, all is well. All right. Let's now see the LWTD chart. This is something which works like magic. I invented it and I'm not saying it works like magic because it's my brainchild. But you connect with me on social media. I update this chart every evening. And I will stand by this chart, and I've been starting to share with you this thing since the last 3 months, and it has an efficiency or a kind of perfection ratio of over 95-97%. Now the daily Impetus has gone higher above 0 as compared to what it was reading on Thursday, which is why on Friday morning I said the market will at least attempt to push back higher, and look what happened. It opened with a gap up. So a Friday closing LWTD is even higher, which means on Monday the markets will attempt to resist a decline a lot more forcefully as compared to Friday. The Nifty advance decline percentage gain or loss line, which is indicated as a blue line here, still remains below 0, which means it's not a gung-ho all firing on all cylinders kind of a rally where you're going to see 3, 4, 5% up move in one trading session. That's not what I'm saying. But what I'm saying is that on Monday, don't expect a slam dunk circuit down kind of a sentiment, because as I'm recording this video on a Saturday morning, unless any barring new negative news coming in, I don't see that happening at all. What's the weekly LWTD chart saying? It basically tells me that the Nifty percentage gain loss line seems to have made a bottom, at least temporarily, and appears to be heading higher after spending 5 weeks below zero. 5 consecutive weeks below zero, it is now rising. Do remember, like I've told many of my friends in via my social media posts, you can connect with me on Twitter, Facebook, or LinkedIn, that I don't take the absolute values of the Nifty. I rather take the percentage gain or decline, so that correlation coefficient is much more smoother, because I use statistical models to trade. So where that is concerned, the Nifty itself shows that it's attempting to make a bottom and try to move up in the green. Do remember, that's only percentage gain loss, not necessarily absolutes. And here again, the LWTD shows that it will attempt to pull the markets higher. The explanation, the tutorial of the LWTD indicator is in the description, in the pinned comment, as well as in the end screen of this video. So don't worry, do see what this indicator is all about. I assure you, your trading will be absolutely transformed if you start using this indicator. And yes, it's free. Now let's see what the four market participants are doing. We start with the FIIs. They've basically reduced their individual stock futures long positions, and they've also cut their short positions on index futures marginally. So net, they don't seem to be doing anything significant here. Where DIIs are concerned, they've cut short their index futures very aggressively, which means they've reduced their shorts, they've booked profits on their short sales. Where individual stock futures are concerned, they've increased their short sales marginally, not too much. Where prop traders are concerned, they've basically reduced their index futures net long positions, but they've exhibited signs of a good amount of optimism where individual stock futures are concerned. Do remember, prop traders are brokers' own trades. They know who's buying, how much, and at what price, so they are second best to insiders. Now for the retail guys who've been doing all the heavy lifting in the entire 2-year bull run in our markets. Now the retail has started to unwind long positions. I will not use the word surrender, because surrender would mean bigger unwinding. This is showing some kinds of worry, some kinds of concern in the bull camp, in the retail bull camp, because both the index and the individual stock futures net long positions are showing signs of falling. Friends, the indicators done. I now come to the bond market. Now, this is a very critical area of the market, which unfortunately seems to be neglected by a vast majority of traders. If you're a banking stocks trader, especially a bank Nifty trader, you cannot afford to ignore the bond markets, because it is the fountainhead of all money supply. And even otherwise, whether you're a banking stocks or a bank Nifty trader or not, the bond market has the capability of dragging the entire market down, which it did. Now, take a look at the yield chart. This is the 10-year benchmark bond yield. What you are seeing is that it might have come down marginally on a week-on-week basis, but it is still at the upper end of that period and far above its 3-month and 1-year moving average, which tells you that the bond market is expecting interest rates and or inflation to rise. Does it mean that the RBI's Monetary Policy Committee meeting in early June is likely to raise interest rates, I think that's a possibility. Now, if that's a possibility, you have a slight problem. What kind of problem? If bond yields are going to go higher and the RBI raises interest rates, the cost of funds will rise. Corporate India's profitability to that extent will get crunched a little bit. Many sectors which are dependent on EMI based selling, demand for their products, will see their demand crunching a little bit. And the cost of funds, like I said, is likely to go up across the board. Stock market senses that, and I've told you many a times that cheap and easy available money is like mother's milk to a bull market. Now, as the taps are getting shut, so also the market is going to get worried that easy availability of money might just stop or at least slow down. So rampant speculation in stocks might just ease a little bit, and therefore prices might hit lower levels. So watch the coming June MPC, or the Monetary Policy Committee meeting of the RBI, very, very closely. If interest rates are rising, then allocation in the mutual fund industry might just shift a little bit. I'm not saying completely, might shift a little bit from equity schemes to debt schemes, because you're now likely to see yields approaching 8% or maybe even higher over a period of time. Now, banks and NBFCs have started increasing interest rates on deposits. It's only a matter of time before the official coupon rates are raised again. Friends, the bond market done. I now come to the US dollar index, the Dixie, which continued to gain on a week-on-week basis. And last week, it gained 0.78% and it rose on 2 out of 5 trading sessions. But those 2 trading sessions were bullish enough to log a week-on-week gain on this index. Now, the daily chart on your screen shows you how the market is, the Dixie, or the US dollar index, that is trading comfortably above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. And as long as that is in place, the short-term outlook remains positive. Although the distance between the moving average and the price has increased, which means a corrective decline can come, but as long as the moving average is not violated, which means as long as the decline does not violate the 102 level on the Dixie, I would say that the bulls still retain control. Shifting you to the weekly chart on your screen, the candle size of the last week is bigger than the week prior to that, which means the bulls have actually shown higher degree of aggression in buying the Dixie and placing it even higher. And the price is far above its 25-week exponential moving average, which is a proxy for a 6-month holding on cost. So even the medium-term outlook remains positive for now, as long as that is still in place. Now, last week I advocated a range between 105.20 on the upside and 102.20 on the downside, which held perfectly well in spite of all the volatility. Now, in the coming week, I expect the upside up to 105.95 and downside up to 102.95. Watch these 2 parameters in the week ahead. Friends, the US dollar index done. I now come to the Bank Nifty. This took the brunt of selling. It fell more than the Nifty 50, and it's also violated a support line, as you can see on your chart, which I have drawn from June 2021. Now, the Bank Nifty fell on 3 out of 5 trading sessions, and Thursday and Friday were particularly vicious as far as the declines were concerned. The price is sustainably trading below its 25-day exponential moving average, I beg your pardon, which by itself is falling, which means the buy and hold trader, the buy and hold bull is now bleeding, because what this chart is not showing you, and what people in the public domain who are giving buy and sell opinions in the social media are not telling you, is that this price chart does not contain the cost of carry, the brokerage, the GST, the exchange transaction taxes, the SEBI turnover taxes, the stamp duties, etc., the transaction costs and taxes that you incur while trading. That means that a buy and hold trader is underwater right now. Now, for the Bank Nifty to basically go up, it should at least go above a previous swing high, which is a long time away. Taking you to the weekly chart, you can see that the last week's candle is prominently bearish. It's a large size candle. It's somewhat away from the previous swing low of March, which was at approximately 32,200 odd levels, but you're not too far away from there. The price is below its 25-week exponential moving average, which is a 6-month holding on cost of a bull, and that average itself is falling since the last 2 weeks, which means the buy and hold trader is really in a soup at this point in time. And as I've sent you a message on WhatsApp on Saturday morning about those 10 charts, that is likely to play out as well in the market. So in the week before last, this index was number 4 on the most volatile list counters. I told you that's a cause for concern. So the volatility has come down on a week-on-week basis, because this index has risen 1 notch and has closed at number 5 on the most volatile list. Last week, I advocated a range between 36,375 on the upside and 32,800 on the downside. That held perfectly. In spite of all that volatility, in spite of all that slam dunk selling, the Bank Nifty's spot market low was at 33,008, which is 208 points above the support that I mentioned. This is all thanks to the work that we do on weekends in IBEX, our statistical trading model. And I continue to share newer indicators, like I shared Impetus, LWTD, etc. that I keep putting up. The next ones are Torque, Ricochet, and they will be shared with my friends on WhatsApp first and in the video later. And of course on social media as well on a day-to-day basis. So thanks to IBEX, we are getting our ranges fine. And in the coming week, I expect a range between 34,900 on the upside and 31,300 on the downside. So do remember 34,900 and 31,300 for the week ahead. Friends, the Bank Nifty done. I now come to the Nifty 50, the most liquid, low impact cost traded instrument in the NSE NSE derivative segment. Now, this index also fell, but not as much as the Bank Nifty, because it surrendered 3.83%. However, as the daily chart on your screen shows, it fell on 5 out of 5 trading sessions. The gap that it left on the way down is yet to be closed. The price is trading sustainably below its 25-day exponential moving average, which by itself is falling. And that means the buy and hold trader, for similar reasons I explained to you in the Bank Nifty, that the holding on cost is not reflected in this chart. Your brokerage and GST and STT, etc. is not shown here. So bulls are under tremendous amount of pressure, and that pressure is not going away all that soon. Will the recent swing low of March hold? Now that is a billion-dollar question. And the one thing that I want my friends to observe in this chart, this is something that I shared with you last week, and I've added some points to the chart. I shared the thick red line at connecting the peaks of this chart, and I told you that the Nifty is showing a falling tops pattern. Now I've drawn a similar thick trend line connecting the bottoms. Do note how the top made in October was followed by a bottom in December, then a peak in January lower than October, but a bottom made in March was significantly lower than the December bottom, and then a peak made in April lower than the peak made in Jan. Will the peak in April, which is lower, be followed by a swing low below the March low? If yes, then you're looking at the possibility of the Nifty 50 falling below the 15,600 mark. In my previous week's video as well, I told you that this possibility needs to be kept alive. I told you very clearly, and I quote, I'm not saying that this is a certainty. I'm just telling you that keep your mind open to the possibility. So yes, that could be a possibility, and once that happens, the bulls are in serious trouble. Do remember that we've fallen 5.5%, almost 5.5% in NSE market capitalization, especially after previous week's 4.25% decline in market cap. This is a humdinger. A humdinger is an event which is a game changer, which can turn the tide. So the bulls are tired. You see another 3, 4, 5% decline in NSE market cap in the coming week. I think the bulls back might just break. So keep the possibility of a new swing low alive in your mind. We are not hoping for it. We are not praying for it. We are traders. We'll play the market when it comes, but this is possible. Now for the weekly chart on your screen, a second consecutive large bearish candle. Although where bearish candles are concerned, this is the fifth one in a row, but the second large bearish candle. The price is below its 25-week exponential moving average, which by itself is falling, which means the 6-month holding on cost of a bull is also making a medium-term buy and hold Nifty trader sweat under his collar, because now he's not able to recover even his rollover costs and come to a break-even point. That means overhead supply is likely. What is overhead supply? When traders who are trapped at higher levels, when they see prices rising and their cost or their break-even point comes, they come and sell. Now that stops the rally in a market. Now this is a distinct possibility across the Nifty and the Bank Nifty and across various individual stocks. People are bleeding where mark-to-market is concerned, and as and when their break-even point comes, they will try to sell. This is a real and imminent threat perception of the market right now. Now, friends, in the week before last, this index was number 13 on the most volatile list, but it's climbed 4 notches to go to number 9. That's worrisome. The Nifty is a broader based index that's getting more volatile. The Bank Nifty is a sectoral index that eased in volatility by 1 notch. The fact that a broad based index is getting volatile tells me that the bid and offer spreads, which means the difference between the buying and the selling price, might just get wider. You might have to chase the price in order to get an order fill, and entry and exit. In professional statistical parlance, it is called egress and ingress, might become a little more difficult. So getting your order fills or order executed might just become slightly challenging. Your cost of trading might go up because the spreads might widen, and that might open up the downsides and the doors to higher volatility in the week ahead. So be very, very careful, my friends. Last week, I advocated a range between 17,050 on the upside and 15,750 on the downside. I admit that range was violated by how much? 14 points. Why? because the Nifty made a low at 15,736 and I said it would bottom at 750. Just 14 points, 0.1%. Now that again is all thanks to IBEX. In the coming week, I expect a range between 16,425 on the upside and 15,100 on the downside. Now friends, both the Traynor ratio and the Jensen's measure have gone even more hostile. Last week, I remember telling you they are screaming caution. That screaming continues. They are in panic mode and they're telling me that one needs to be extremely cautious, especially the leveraged long traders. If you're holding long positions and you're thinking you'll pay mark to market and it'll go away, it's going to be a little bit of a challenge for you. So be particularly careful about this. And do remember that a rising dollar is not good for emerging markets, including India, because everything that we import will become more expensive. We'll now import inflation, and inflation is good for no one. And within a fortnight or so, you'll start having a second guessing about the RBI's Monetary Policy Committee meeting and interest rates, etc. Those worries will come back to haunt traders. Now, these are factors that can keep markets under pressure. So, what is my overall view? Am I skirting the issue about whether the market can bounce back or not, which I promised to look with you? I'm not. I'm coming to the crux of what I feel and what my trading strategy will be. Overall, I'm expecting the markets to fall. Net, broad. Intermittent rallies or pullback rallies, relief rallies, dead cat bounces, bear market covering, call it what you want. Yes, those are possible. And they are always happening in bear markets. Those will keep coming and going. But what am I seeking? I'm seeking levels to short. Would I buy as a micro trend trader who keeps his trades alive for 59 minutes and 59 seconds? I'll swing any which way the market tells me to swing, as long as I can put food on the family for my food on the table for my family. I'll trade anyways, but my bias is towards caution because I'm expecting pressure on the markets to continue. This is a time to be extremely cautious, and if a newbie trader thinks that this is the end of the world or end of the market or end of his career in the market, I think you guys are wrong. It is a beautiful thing to be a trader in the market because you can trade on both sides of the market. You can make money while the market is going up, and you can short the market and make money when the market is coming down as well. Just make sure that you're on the right side of the market rather than trading against it. We are there to help you. We are there on social media, putting out all our secret in-house exclusive indicators for you to benefit from. We ask you nothing in return, no monetary compensation. It's all free for you. And I want you to basically start making a better trade efficiency ratio, which I have explained to you in this secret ratio, which I've recorded in the video. The hyperlink is down in the description and in the pinned comment. Do make sure that you make a success out of yourself and trading these markets. That's what my channel is all about. That's what I'll continue to do. And that is something I assure you of. Friends, the indices done. I now come to the most popular segment in this video, wherein I give you 5 stocks that are high beta, high impetus, where you take small exposure, wait for large price moves and get a higher trade efficiency ratio. Remember the video that I talked about the trade efficiency ratio? The URL is all there in the description and the pinned comment and the end screen. And there are 5 stocks that are low beta, low impetus, where you take big exposure and wait for small price moves. These are primarily for scalpers. And this week around, do remember there's a change. This stock list is valid on your screen only for Monday. Tuesday to Thursday, every day's low beta, high beta stocks, 5 in number, will be WhatsApp to you every morning or preferably one night before so that you're well prepared. This is a complimentary service. Feel free to jump in. My contact coordinates and WhatsApp number comes at the end of this video. So let's dive right in. The high beta list is led by NTPC at number 1, number 2 Coal India, number 3 Tata Steel, number 4 Punjab National Bank, number 5 Rain Industries. The low beta, low impetus stock list is led by Mahanagar Gas at number 1, number 2 Bajaj Auto, number 3 Coromandel, number 4 ICICI General Insurance, and number 5 Hindustan Petroleum or HPCL. Friends, this hierarchy of high and low beta stocks changes from hour to hour, day to day. So do remember, this list is valid only for Monday. On this cheerful note, my friends, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Good, bad or ugly, I'd love to hear from my friends and my viewers in the comment section. And please share my videos with smart traders like yourselves who are looking for data-based, logic-based trading inputs, and help me reach a wider audience. I wish you have a very, very profitable week ahead, my friends. Thank you for your patience till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.